Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Phil Orlando of Federated writing this: we're not buyers of the SPX whole hog here. However, we still expect the rally in stocks will broaden out from Mag 7 centric to include domestic large cap value, small cap growth and international. Phil, I'm pleased to say, is with us now for more. Phil, let's get straight to it. The data of yesterday, how much weight would you put on that manufacturing read?
John, good morning. Thank you again very much for having me back on. I think yesterday's data was very significant. That the ISM, as you guys pointed out, was back above the 50 level, the contraction line of demarcation, if you will, for the first time in 16 months. And as Lisa pointed out, the number that was stunning was the prices paid component. So you've got a situation where the economy is strengthening, yet inflation is sticky, perhaps even accelerating. Now, pair that with the LEI data we saw last week. Leading economic indicators, it went back positive for the first time in 22 months. And you sit down and talk to our bond people, and they look at these inverted yield curves that we've been watching for the last 2 years. Funds to 10s, 2s to 10s, 3-month to 10s. They're flattening out. Our bond guys think that those may become positively sloped again. So the risk of recession or lower risk of a modest soft landing is starting to shift to a stronger period of economic growth. But the inflation question, I think, is the more important one. Look at last week's PCE print, core, 2.8% for the month of February. Now, what really caught our attention was the changes in the SCP at the Fed's last meeting. They're going to increase their core PCE forecast to 2.6% for next year and kept their 2% target in place for calendar 26. So the Fed is telling us that inflation is still a problem. It's going to be a problem as the economy comes back. And what all of that means is that there's going to be less rate cuts relative to what the market was expecting just a couple of months ago.
So, Phil, given everything you've said, every item on that list in the last couple of minutes, is that good or bad for stocks? Let's make it really simple. Good or bad for stocks?
So, S&P 500 up 10% here in the first 3 months of the year, up 28% since October. In our view, stocks are ahead of themselves, but we expect sort of a rolling correction, if you will. The Mag 7 in the last 15 months is up 99%. The forgotten 493 is up 22%. Our view has been that this rally would broaden out, that we would see some profit taking in the Mag 7 and the domestic large cap value stocks, the small cap growth stocks, the international stocks, which were largely left for dead over the course of the last year or so, they would find some love and we'd start to see some improvement in the share prices of those categories.
But Phil, how much do higher rates really challenge the idea of broadening out, particularly to small caps, considering that these companies usually are more leveraged and are more vulnerable to higher rates?
Fair point. But remember that the U.S. economy is doing relatively better than a lot of our trading partners, Japan, Germany, UK, all in a recession. The reality is that small cap companies here in the United States do 80% of their business right here at home. And from an economic standpoint, we're doing better here. In terms of underlying fundamentals, the sectors within the small cap market, biotechnology, for example, is our favorite, is really well positioned. Biotech stocks have very strong pipelines. The valuations have probably never been cheaper. And with interest rates down at the margin, the prospect of M&A activity is enhanced today versus where they were a year or so ago. So we do like small cap here.
What about oil? How much is oil the new Mag 7 at this point, where people are talking about the fact that suddenly there is the reality check of supply and demand and the fact that this economy isn't rolling over the way so many people thought?
music to our ears, Lisa, that we were very lonely at the beginning of the year talking about oil, WTI in the mid-60s, thinking that we could see $80 to $90 a barrel by the end of the year. We're now sitting in the mid-80s 3 months into the year. So this has happened a lot quicker than we thought. But the combination of increased geopolitical risk in combination with the fact that we don't have a lot of levers here. In the past, we might have utilized the Strategic Petroleum Reserve to perhaps adjust the price of oil. We took the SPR down 350 million barrels a couple of years ago and didn't replace it. So at this point, we are sort of at the mercy of the vicissitudes of what's going on globally. Crude oil last September was at $95 a barrel. We could see the crude oil market retest that. Gasoline prices at $3.50 or so a gallon now could be at $4 over the course of the next couple of quarters. So this move in energy for us is real, and energy has been one of our favorite categories on the domestic large cap value side.
Well, Phil, with Brent already trading within your range of $89 a barrel, what do you see for year end?
Higher. We think that
100?
WTI could trade up another $10, and Brent, maintaining that spread could probably approach $100 a barrel.
Phil, when we were talking in early November and you were talking about double-digit rallies on the S&P 500, did you ever expect things to go as far as they have in the stock market?
Not as quickly as it has. That we've got a 6,000 target on the S&P, fully discounting calendar 2025 earnings. The market seems to be focusing on that number. We didn't think that we would get up, the 52, 5,300 level in the first quarter of this year. So the rally, this 28% rally we've seen over the last 5 months, has been much faster than we had expected last fall.
So much faster. Great to catch up, Phil. Thank you, sir. Phil Orlando there.
Thanks for having me.
At Federated Hermes. Gayeski of FS Investments saying the performance of the US economy is an opportunity for a spring cleaning of portfolios, writing this: cash has been a great place to hang out for quite some time and still offers a positive real rate of return, but gradually deploying those massive cash hoards into a select group of alternative strategies can substantially increase return potential without having to take on uncomfortable levels of risk. Troy, I'm pleased to say, is with us now for more. Troy, I want to reflect on the data we've had so far this week, going into a week full of economic data, really concluding with payrolls on Friday morning. Would you see that data, that strength, as a good thing or a bad thing for risk assets?
Well, for risk assets, it still continues to be a good thing over the medium term, in that stronger economic growth leads to more revenue, leads to lower default rates and credit. We're getting to that inflection point, though, where you had a violent enough curve move yesterday that equity markets finally paid attention, right? If you think of Q1, you had another quarter where fixed income was down, like a broken record, like we joke around about. But equities were able to power ahead because not only did you have very strong earnings, but obviously the economic growth surprises were relatively robust. And Powell started to jawbone about, some would say, premature cuts. So, we're at a more dangerous level in terms of valuations, but generally that rebound in manufacturing should be looked at as a positive outcome and a positive driver.
Troy, you say the equity market started to wake up. I mean, I've got a question now. We were down 0.2% yesterday on the S&P. We're down 0.2% this morning. I think the equity market's still snoozing, isn't it?
Yeah, well, compared to previous higher rate-driven dislocations, I mean, the most recent one, of course, was August to October of last year, where you got a material curve move. And, 0.2% is kind of a rounding error. But, at 21 times forward earnings, you just have to ask yourself, how much more upside do you have when so much of the good news is priced in? And to the points you've been making already, there's a material risk of substantially higher rates at the back end of the curve. We still are fairly inverted. The curve has obviously been gradually pricing out cuts this year. But bottom line is, to Lisa's point, in the scenario where there are no cuts, you have to think the back end of the curve is going higher. And we could retest the 5% level at some point, given the substantial supply that's coming on, and obviously a technical picture that's not terribly supportive.
Does 5% this year?
We have thought, and we still think that's definitely possible. I mean, look, the way when you think of the forward reaction function for the Fed, right, we've always said that this cutting cycle is going to be the mirror image of the 15 to 18, this hiking cycle is going to be the mirror image of the 15 to 18 cutting cycle. Very slow and steady. And there's a reasonable probability that as the Fed first starts to cut, the back end sells off as inflation expectations get anchored higher. In the event that they don't cut at all and they continue to pursue QT, which they still are, as you know, there's certainly a risk that we make higher highs this cycle. And that's one of the risks that markets have priced out, we think, far too fast, particularly late last year and early this year. It's not that fixed income is tragic like it was in 2020, early 21. Or late 21 as well. It's just that the risk reward still isn't fantastic like many people have been articulating it is.
I love the idea of fixed income as tragic, Troy. There is this question, though, about what assets get hit hardest. If a 10-year yield does climb back up to 5%, it starts to retest some of these levels. Is it just public equity markets, or is it also some of the private markets that have seen incredible amounts of cash flow in that are kind of pegged to floating rate types of instruments?
Yeah, so I think when you start with private credit as one example, which has been an area of tremendous growth and really very attractive positive returns, not only in 21 and 23, but also in 2022, where the index is up roughly 6 to 7% in a very tough year. So you're always rooting for higher front-end rates for longer, with the lowest probability of that tighter Fed policy cratering the economy. Right. And that's why when we first came up with this scenario last year, we called it the Dare to Dream scenario, because, from a probability standpoint, it was almost too good to be true. But of course, that is now the base case where the Fed has hiked a lot. They're keeping rates higher for longer, and the economy continues to be incredibly robust. However, to your point, if you get a high enough back end and financial conditions tighten enough, that could lead to slightly higher defaults over time. So you give back some of that excess income in the form of defaults. But so far, what we're seeing is very low default rates, the ability for companies to restructure with strong-handed both private equity and public equity partners. And that means less income being returned through defaults, which is really as good of a scenario as you could hope for in private credit markets.
I get the sense, and it's not just from you, Troy, but a lot of investment managers who come on say, cash, you're running out of time. You got to deploy it, whether it's alternatives, whether it's into other parts of the equity market, the, forgotten 493, as we heard earlier. Is there really a sort of pressure for time for cash? And no, I'm not just talking my own book, but there is this question of if the Fed's going to hold rates higher for longer, and it doesn't seem like this is that restrictive, why couldn't you clip 5% on a money market fund for the foreseeable future?
Oh, yeah. Look, we've argued for the last 2 years, right, that what you want to focus on is Northwest Quadrant strategies that have higher returns with lower risk. And cash actually is one of those alternatives to traditional fixed income and also equities. However, when you look at where you are today, really 5.25, 5.5 is the peak, right? The probability of the Fed hiking from here has always been non-existent. It still is non-existent. So you only have one way to go, and that's lower. Now, as we've discussed, it's going to be very slow, very plodding, cutting cycle. So you'll still have income. But the question is, when you think of, whether you're looking at actuarial studies or what folks need to retire comfortably, typically you're in that high single digit to low teens range. And the question now is, should you at least gradually think about deploying, that extra $2.5 trillion in money markets, that extra $4 trillion in commercial bank deposits into strategies where you're not taking uncomfortable levels of risk. You're not going to walk into a potential 10 or 15% drawdown, or if you're in equities, or you're reaching for duration right now, as many have done the past 2 years, much to their chagrin, and you take a 5 to 7% duration-related drawdown, where you have you're conceding liquidity. You're going to have marginally more risk, but you're boosting your return potential to high single digits to low teens. And, one of the unique things about private credit now, which is really fascinating, is that you actually have potentially higher returns in the debt part of the capital structure than the equity part of the capital structure, right? Because that extra debt service payments that go to the lenders comes at the expense of free cash flow for a lot of mega cap LBO firms. So the equity forward returns there will be lower to the benefit of the debt holder. So it's an unusual period of market history for sure.
I love how Lisa talking her own book is standing cash. And for a lot of people, it's single names, right? But for Bramo, it's standing cash.
I'm just look, I'm not, showing my hand too much. Actually, carry on. We don't have to continue.
Sorry, I want to squeeze this in. Actually, it's a random question, so forgive me for this. The FT had a strange front page yesterday, and I'd love your thoughts on it. It was about the record supply, the bond issuance we had in the corporate debt market, and this really odd link about the election in the back end of this year. And I had to say, I hadn't even thought of that. Are we linking the boom in supply in the first quarter of 24 to the prospect of the market closing up in 4Q this year?
I think that's a bridge too far. I think what's really happened here, again, in our investment committee meeting, we discussed that a lot of the explanatory variables for what's going on in terms of market price action, as well as in terms of risk appetite, gets back to those huge cash hoards that the Fed created during, the pandemic and still lurk with us today. So what we've seen across the board, whether it's, middle market corporate lending, whether it's senior secured commercial real estate lending, whether it's high yield bonds or IG, and even agency pass-throughs, which really have the horrific technicals, is a gradual, steady, relentless tightening. And obviously issuers are taking advantage of that, and they're looking at the past 2 years and they're thinking the next 6 to 9 months forward. This is probably one of the better points to issue new debt and lock in new financing. Or just as critically, if you have a roll date coming, whether it's floating rate debt or fixed, this is the window you're getting. And if we do have turbulence at the back half of the year, you're probably getting better pricing now than, perhaps in Q4. But I think that's a stretch.
Very diplomatic, even calling it a stretch. Troy, thank you, sir. Troy Gayeski of FS Investments. Joining us now to discuss is Stephen Cook of the Council on Foreign Relations. Stephen, wonderful to get your insight, your valuable insight on this program this morning. Could you talk to us about possible consequences from that strike in Damascus?
Yeah, this is a significant escalation, and the risk of the Iranians responding in any number of ways is very, very high. The Iranians have attacked American forces, and American forces are in Iraq and Iran, which are obvious places. We've seen that happen over the course of the conflict that began on October 7th. There is also the very real possibility that whatever restraints the Iranians have placed on Lebanon's Hezbollah may start to loosen. There's already a very significant conflict between Israel and Hezbollah. The two have been trading fire since October 7th, and strikes against each other's countries have been getting bolder and deeper in recent weeks and months. So this is a very big step for the Israelis, who quite rightly point out that the multi-front conflict that they are fighting is a consequence of the Iranian sponsorship of the axis of resistance in the north, obviously in Gaza, as well as the Houthis' unrelenting fire on Israel from Yemen. So the Israelis clearly want to go after what they consider to be the head of the snake.
Iranian Foreign Minister Amir Abdollahian in the early hours this morning said that he summoned the Switzerland envoy to give a message to the United States. Potentially this is also going on with maybe back channels in Oman. What kind of back channel do you see potentially between Washington and Tehran to try to take the temperature down?
There is and has long been robust communication between Tehran and Washington through the Swiss embassy. The United States communicated to the Iranians at the outset of the conflict, communicated to the Iranians after the incident in Tower 22 when 3 American soldiers were killed, that the Iranians needed to back off, otherwise there would be very significant consequences for them. I imagine the Iranians are using that in reverse, communicating to the United States that unless Washington brings the Israelis to heel, the Iranians have the capability of raising a storm of violence in the region.
How close are the Americans to bringing the Israelis to heel, given the fact that they had this call yesterday, a strategic call, and then potentially we are going to see Israeli officials in Washington next week?
I think that the American influence on the Israelis at this point is rather limited. The Israelis frame their conflict with Hamas, and in fact their conflict on multiple fronts, as an existential threat. Under those circumstances, although the United States is obviously an important strategic partner of the Israelis, advice given is not always advice taken. We have seen this throughout the conflict. President Biden believed that his bear hug of the Israeli government would give him the leverage with the Israelis to shape their military operations in the Gaza Strip. That has not happened. So the conversations between Washington and Jerusalem yesterday, virtually, and next week's meetings are about Israeli planned military operations in Rafah. Prime Minister Netanyahu said those plans have been approved and the IDF is ready to execute them. It's unclear whether these talks will bear fruit for the United States in shaping the way the Israelis undertake this operation.
Stephen, there are a lot of moving pieces here, and you honed in on the northern border of Israel, the border with Lebanon, the Hezbollah conflict that has been ongoing for a long time, the tit for tat, and that being the true source of an escalation that could draw in a larger swath of the region and potentially disrupt things like oil markets. I'm wondering how close you think we are to that. If you could quantify how much closer we are now after these assassinations than we were before them, it would be really important, because this is really what a lot of strategists are honing in on this morning.
Well, it's hard to put numbers on it, especially for historically minded political scientists like myself. But I would say that it is a strong likelihood that we will see a significant conflict between Israel and Hezbollah in the north. The constraints on both parties have been loosening in recent weeks and months. The strike in Damascus yesterday that killed 2 IRGC generals are something that the Iranians are going to be unable to not respond to. I think the only thing really holding the Israelis back right now is in an odd and twisted way is congressional dysfunction. The Israelis need that security assistance that has been locked in Congress in order to acquire the kind of precision munitions they would like to use in a conflict with Hezbollah. But I think in the next 4-6 months, we're likely to see a major escalation in the north.
What's to stop that from percolating out into a broader region that really does disrupt broader trade markets in a way that a lot of people have suspected was the worst case scenario?
Yeah, I think the major factor here is that the Israelis and Hezbollah get involved in a major conflict, that the Iranians and the Houthis continue to interfere with global shipping, and meaning also for the oil markets. Neither Israel nor Lebanon are major players in the energy markets, although there's a lot of gas off both their coasts. But the knock-on effects in which Iran and its axis of resistance can disrupt the global economy, as they've done or tried to do in the Red Sea, is something that I think everybody needs to be well aware of.
Stephen, appreciate your time this morning. Thanks for your insights, sir. Stephen Cook there of CFR.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.